Let's ask the community.
Hey, Equity Mate.
I just had a question.
Hey, Bryce, friend.
As always, we love hearing questions from the community, and we have 2 questions today that are about emerging markets. And just a reminder, if you want to leave us a voice note, there'll be a link in the show notes to do so. But Ren, what have we got?
So the first question is from Amar.
Hey mates, just wanted to get your perspective on emerging market ETFs. Right now, I'm just investing in two ETFs, VAS and IVV, and just kind of dumping my money into there every fortnight, basically. And I was just wondering, because I'm looking at diversification, but whether emerging markets make sense to add to a portfolio. I feel like the general consensus is that long term, the growth just isn't there. Most of the countries are very unstable, very volatile. But on the other hand, I just feel like that, considering the size of the countries, of the economies, and stuff like that, that it's so hard to ignore as well. I just wanted to get your perspective on, do they have a place in a portfolio? Are they necessary? And what do you think of them? Thank you. Love the show.
Good question. Next one, though, is from Steve. Is that right?
Yes, that's
Nice.
right.
Hi, Bryce. Hi, Ren. Love your work, guys. Just considering in diversifying into emerging markets and wondering what your thoughts were on putting VGE into your portfolio just as a satellite, just for some extra diversification. It's a bit dear at 0.48 basis points for their fees. And I'm just wondering, with nearly 6,000 holdings, is over-diversification a problem? What's your thoughts?
Wow, 2 solid questions.
Yeah.
Thank you to Amar and Steve. And as I said, if you want to leave us a question, there's a link in the show notes. A lot to unpack there.
Yes.
So let's work our way through it. Emerging markets.
Yeah. And specifically emerging market indexes.
ETFs, yeah.
No,
or indexes.
indexes.
Yes,
Yeah.
Yes.
So let's start with the conventional wisdom, which was that emerging market indexes, where you market cap weight companies from the largest company to the smallest company, and you just buy that index. Emerging market indexes were not seen as a great place to be.
Yeah.
Now, why is that? The top of those indexes were generally slow-growing industrial companies, often with like pretty strong ties to government, sometimes quite reliant on government contracts or government largesse, depending on the country we're talking about. And the exciting elements of emerging markets, those faster growing consumer companies or technology companies, were much further down the index. Or most importantly, and this was the really important thing, most importantly, some of those technology companies were listed in other countries entirely. So, for example, Africa's Jumia, not listed on an African stock exchange.
Yeah.
Mercado Libre in South America, listed in the US,
Yeah.
not listed in a South American stock exchange. C Limited, the Southeast Asian super app, not listed in Southeast Asia. All 3 of those companies are listed in the US. So if you were to invest in one of those regional indexes, trying to get exposure to those companies, you actually wouldn't have got them at all.
Yeah.
So that was the traditional view.
Yes.
That emerging market indexes were not filled with the companies that excited you about emerging markets, and they weren't a great place to be.
Yeah. Then the flow from that then logically was, if you want to make an investment into emerging markets and small caps, active management is probably the way to go. Taking the index for all those reasons is not right. However, times are changing, Ren.
Times are slowly changing.
Those tech companies that were traditionally found themselves in the bottom of these indexes, they're now finding themselves at the top.
Yeah. The first example we have here is the Hang Seng, which is not really an emerging market index. It's the Hong Kong index. But
exposed to emerging economies.
To be honest, if you look at the CSI 300, which is like the mainland China 300 biggest companies,
massive.
It's just a story of pretty boring and uninspiring companies at the top of it.
Right.
Which proves the point around emerging market indexes.
Yeah.
The Hang Seng is now where a lot of China's technology companies sit. Meituan is the biggest, Alibaba, Tencent. Side note, not the point of this segment, but it's crazy that Meituan, which is like the food delivery app, is now bigger than Tencent, which owns the super app which Meituan was built on. Like it was built on WeChat.
I've completely lost track of Tencent, where it's at.
It's
up 41% last 12 months.
Yeah, it's still a pretty incredible company.
Yeah.
But
Anyway,
Not the point.
side note.
If we look at India,
Yep.
so Reliance is the second largest company. Infosys is the fourth largest. Reliance is a funny one because it was an example of a slow growing industrial company, but now it's like super exposed to all the technology story that's unfolding in India with Reliance Jio. And if some of these companies are not super familiar, don't worry about it because we'll get to a point eventually. But I think Steve asked about VGE, the Vanguard Emerging Markets ETF.
Yep.
And if you look at VGE, some of the top holdings, tell me if these names excite you. Taiwan Semiconductors,
Yep.
Tencent, Alibaba, Meituan, Reliance in India, HDFC Bank in India, Pinduoduo, which is the owner of Temu, for people who are unfamiliar, Infosys, Hon Hai Precision Industry, which people may know as Foxconn, the company that makes iPhones for Apple, and then China Construction Bank. So that's the top 10 in VGE. And there's some pretty exciting companies there. Technology companies, semiconductor makers, electronics makers, like...
Didn't know that Pinduoduo owned Temu.
Yeah.
I hate Temu.
You hate it?
I hate going on the app.
To be honest, I have a theory about Temu, which is like it's super problematic, but people are slowly going to keep using it because it's just so cheap.
Well, yeah. But gosh, it's annoying going on there. Anyway, that's another side note.
So you look at VGE and you say, okay, well, maybe some of that traditional view of emerging market ETFs no longer applies. Maybe there are more interesting and exciting companies sitting in the top of these indexes.
There might be, but I think the second part to Amar's question is the more interesting / worthy of discussion, which is the risks that come with it and the performance.
Yes. There are a number of risks, and there's the currency risk. So like a lot of these emerging markets, generally their currencies underperform the US or just more developed market currencies. And unfortunately, the investments are priced in local currencies. There's geopolitical risk, always governance risk and sovereign risk, especially with China. If you think about a couple of years ago where China just took a massive whack at the tech industry because they didn't think it was in line with sort of China's social values. There's concentration risk these days. Emerging market indexes are dominated by China and India. But I think the biggest risk of all, and the risk that Amar was alluding to, is underperformance.
Yes. So Steve spoke about VGA, the Vanguard Emerging Markets. Over the past 10 years, it's done 5.85% per annum. Now, if you compare that to IVV, which is the S&P 500, that's 13.34% per annum, so more than double. IOZ here in Australia is 8.76% per annum over the last 10 years. Pretty significant underperformance versus, I guess, where else you could be putting your money.
Yeah, and you're getting worse performance for more risk. Like emerging market economies are generally riskier. And I think the important thing to stress is where we started this conversation is people generally say if you want to invest in emerging markets, you need to think active.
Yeah.
But if we look at ASX listed active ETFs that invest in emerging markets, the story isn't a lot better. So Fidelity Global Emerging Market has beaten the index. It's done 8.5% per annum since inception in 2018. So that's done meaningfully better than Vanguard's Emerging Markets Index. And BetaShares also have an active emerging markets ETF, the Martin Curie Emerging Markets Fund. Since inception in 2019, 4.9% per annum.
Yeah. So underperformance.
Yeah.
Yeah.
So I think if you want to invest in emerging markets, you have to believe that that level of underperformance is going to change. Because I would just argue otherwise. Like, you're taking more risk, you're getting worse performance. What are you doing?
What are you doing? Yeah. Well, neither of us have either an index or a managed fund that give us exposure to emerging markets. And for me,
are you not in the Nifty 50 ETF?
No.
Yeah.
No. For me, that's different though. For some, I think about that differently.
India is an emerging market.
I know. I know. I don't know why, but yeah, I don't have exposure to it.
Yeah, but I feel like that's the interesting thing as well. It's like, so India and China dominate the emerging market index, but the emerging market index has massively underperformed just investing in India, and that's because China has been an underperformer.
So I think to your point, Ren, around you need to believe that it will outperform. I think why I think India, I separate India from the conversation we just had, is because I do believe that it has potential to outperform that 8% per annum. If you even look at the last 12 months, it's up 27%.
Yeah. So I guess then in that instance, you would say invest in India, don't invest in emerging markets broadly defined.
Yeah.
But look, there's nothing wrong with investing in emerging markets. We should be very clear. It provides diversification to your portfolio. It will pick up some of these more interesting companies that now top the index. That might change, but how I would think about it is going in eyes wide open about its historic underperformance, and I would need to have some level of a conviction that would change. And I would be thinking about it like a satellite position. I wouldn't be buying it, putting it in a bottom drawer and not looking at it again, just because I don't think, for all the reasons we touched on, I just don't think that's how you should think about it.
Yeah. Well, thanks for the questions, Steve and Amar. As I said, make sure you leave a voice note if you would like to get a question on the show, and we'll make sure that we get it on and answer it.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.